How successful is volume trading really? Forget it to choose only the volume. You have to take other opportunities together with the volume, that you understand the stories behind, that you understand where the global money flow is coming and where it breaks, where you have opportunities for fast trades and where you can choose intraday swing trading or counter trading setups for you. And if you would like to learn it and if you would like to understand it very deep, listen today. I translated this video with AI because my English is not perfect, but I think you will love this video and it is amazing. The stuff inside is so perfect for you. I give you this gift because I love it to explain everything from the markets. Take it and like it. Thanks a lot.
Today, I want to tell you why I don't analyze trading volumes or turnovers in isolation. I analyze them because in the end, it doesn't lead you to the point you need in order to logically deduce something meaningful from trading volumes, what really matters for you. First, you need to know, are the trading volumes for the respective instrument high or low? At what times are these trades taking place? And if you then refer, for example, to older time frames, where you can check how things were at the same time yesterday or the day before yesterday, at the same time and so on, then you get a better overview of whether the trading volumes are declining, staying constant, or even increasing. And then you get indications as to whether these trading volumes can actually be useful for your goals. Because whenever trading volumes decrease, supply and demand are no longer as high. This means that fewer large market participants are interested in being active in the markets at that time. And now, just imagine you do the following. Let's start by simply getting an overview of whether trading volumes remain consistently stable at the respective times or not. Some of you might be thinking right now, what kind of boring nonsense is this? But I want to show you something, and it's really, really important. For example, here, this is the DAX future, and here we have the market opening. And these are the trading volumes even recorded in delta. That means I can see whether, for the corresponding volumes, there were more purchases or sales made. So what information do I have now? I have the information that in this time frame, about 600 contracts were traded in the first 5 minutes after the market opened. Now, just imagine the day before at the market opening, 800 contracts. The day before that, maybe you even had 1,000 contracts at the market opening. What does that immediately show me? It immediately shows me that the inflow of funds that needs to be placed in the market right in the morning is decreasing. Or conversely, it's increasing. And whenever that's the case, I know there's liquidity that needs to be placed in the market. But I still don't know whether the markets will rise or fall as a result. In short, this information tells me simply a hint as to whether I should expect activity or whether the markets are more lethargic or slow because no one is interested anymore. The second thing I really like to look at is, what are the trading volumes during the closing auction? That is, from 5:30 p.m. to just before 5:35 p.m. That's the moment in the DAX future when the futures prices are settled at the cash close. This means that the earlier physical trading on the stock markets comes to an end at that point. Now, you need to know that many large institutional investors buy or sell their positions during the closing auction. Positions they still hold during the day and need to adjust. What does that mean? It means that if, for example, as a large trader, you have the order for today, let's just say a number, to place 150,000 Adidas shares on the market. And over the course of the day, you've managed to place 80,000, then you'll bring the remaining shares to the market during the closing auction. Because it's precisely in the closing auctions that you often find trading partners who want to buy or sell in large blocks. So, the information tells me how many contracts are currently being traded in the closing auction. It's always a good indicator for me to know whether there is still a lot of demand from large market participants to enter the markets or not. You have to understand, large market participants need sideways phases, like here, so they can position themselves in the market at fair prices. Large market participants need time to secure fair prices in the market. They really don't like it when the markets are extremely volatile. And that's the reason why both the market opening to see what's happening in the morning and especially the closing auction give me very important indications of how I should assess the volume. And that's the first building block you should get to know in order to develop an awareness for it. Let's take it a step further and look at these profiles here. This is market profiling and volume profile, each viewed over a period of 1 week. And now, as I said, it's not enough to just look at the volumes. Here, for example, you can see the point of control from this volume profile. What else can I see? I can see that there were strong buys down here, but also strong sells at the top. So I immediately recognize that the supply and the demand can be considered as being fairly well balanced. So I know that as long as the market fundamentally stays within this particular zone here, as we just observed, the fair and equitable prices are initially accepted by participants. And that's good. So what happens in the following week? And that's really, really good to take a look at. The market opened above this, above the fair price level, and then it dropped and even closed down here. What indication does that give me? And here, you really have to look beyond the obvious. I want to show you this is the corresponding volume that was traded during this week. And I'm making this very deliberate, a bit larger up here, just to bring some logic and understanding to it. Now comes the next part, as we just looked at. Down here is the closing price for this week. And we said that closing prices are an important indication for us to examine how the market is positioned at the end of trading. And what you can see here for this week, at this closing price level, there was little trading volume. And the logical consequence from this, since we also have the point of control, that is the volume-weighted center of gravity, up here, the market moved back up again the following week. Why does it do that? Because if we go back to the major market participants, they are always looking for locations where supply and demand are in balance. And up here you can clearly see and recognize what happens when supply and demand are rejected and shift downward. But that by no means implies that the markets will collapse or anything like that. It simply gives us an indication that fair prices are shifting downward. And if I now have the following information, on the one hand, a rejection at the fair prices, and on the other hand, and this is the essence, the most important, a shift of the fair prices to lower levels. This situation gives me the opportunity to first determine, okay, there is real selling pressure because the trading volumes are decreasing. However, if I then notice that the market, below these fair price levels, below the value areas, does not have any significant trading volume. And in addition, that not much happened at the closing price this Friday either, then I can deduce from this that there are probabilities, meaning that the market, with a higher likelihood than continuing to fall, will first return to this equilibrium level. And such information is extremely useful for us because there is logic behind it. Let's also take a look at the whole thing in a footprint chart. Because here too the logic is no different. We can look at these nice footprints, and as I have explained to you very clearly, for example, up here we lost interest. Here, on the other hand, the trading volume was highest in this price range. Below that, everything was a bit less again, and down here, the trading volume was very high again. What does that mean when I look at it? So here are the corresponding volumes. For me, this means the information I need now is, what happens if we move above these volumes? What happens if we go below these large volumes? So, is the market interested in establishing new fair business below that? So can we expect real volume there at lower prices? Yes, then the market is simply doing nothing other than accepting lower prices. And greater acceptance of lower prices means that, for now, the probability is high that the downtrend will continue. It's the same to the upside when we move over, and you can see it beautifully here. As liquidity shifts upwards, there's simply a high probability that the market, as long as it doesn't take out these deeper real volumes anymore, will move from here to the upside. And as you can see here, this is a price area where I need to watch. If I get a pullback in the market, whether it might be a good idea to take another long trade from here. And all of this comes from the simplest logic of supply and demand. So we understand that openings and closings, that is, the determination of opening and closing prices, happen in the cash time frames, are very, very important and interesting because we understand why the big market participants like to use these times and hours to conduct their business. We understand that by analyzing the volume profiles, we can determine and identify where fair pricing is. Then when you combine that, together with the corresponding closings, this gives us awareness. Awareness of how we can anticipate when the market is striving to return to equilibrium or when it is rejecting it. And last but not least, we can very nicely observe whether it really is the case that when we get a setup at, for example, such a price level, the market actually tells us, yes, I accept the higher prices, or tells us, no, I'm not interested. And for that, I need to look at what happened at the top, what happened at the bottom. And how can I piece together a matrix from that to make the whole thing smart? Let's explain the whole thing again in a really simple way. Let's assume a market moves like this. And here I am. So what do I need now? Now I need the information. Where were there large volumes traded? Let's just say there were large volumes here and the market comes back down here. So what do I have to do now? I have to check whether the volumes have really shifted upwards, and then I can wonderfully look for a new entry for myself. And these are the simplest approaches where in the end, you just have to look out for smart setups so that you can clearly and easily determine where does my stop loss belong? Yes, below the last volumes. And where are my targets? With high probability, they're where there used to be large volumes in the past. And that's the result when you can correctly count the volumes with the corresponding volume data, interpret them properly, and know which volume sizes are typical for each instrument. For example, S&P future, DAX future, or crude oil. So we need to know when are they actually large volumes, how can I read that here? And we need to know when volumes are rather small. And there are many great tools for that today. And I am convinced that this video was incredibly helpful for you. Thank you for listening. It was a great pleasure for me again. And I am firmly convinced that this sequence of logical consequences will lead to a significant improvement in your trading. Enjoy it.